Thank you to the 3 additional students, total of 8 now, who responded to the Chapter 4 survey. At least now we have some trends that I can speak of. 50% said they were confused about salesperson allowances versus non-salesperson. So what is, I guess, allowed versus not allowed, what is reasonable, et cetera, et cetera. And you may recall we had this diagram on the board. And we were looking at page 80. I'll ask you to turn to page 80. And this is about whether the allowance is tax-free or not, right? And you recall that for a salesperson, for a non-auto allowance, so anything other than auto, what that generally means is travel that's not related to car.
So by that, do you mean hotel and airfare and
Yep, meals,
meals?
yep.
Okay, thank you.
It simply has to be reasonable. If it's reasonable, then it's not taxable to the employee. And an auto allowance also just has to be reasonable. And if it is, then it's not taxable to the employee. For non-salespeople, it's all the same, except that an allowance for a car, for use of the employee's car, has also to be based on kilometers. So if this person gets like $200 a month or something, right away it has to be included in their income, even if it's a reasonable amount. Because it's just a blanket thing, it's not based on kilometers. That's the whole story. Is there any part of that that you need me to elaborate on or that you have a question on?
Sorry, can you repeat what you said? It's for the auto, that if they receive an allowance, that they have to include that in, or is it for the non-auto? Sorry,
No, this is only about the auto.
Okay,
And if they just get a blanket payment, as my example, say a couple $100 a month, boom, right away, taxable.
if they mention anything about kilometers though, then we know it's reasonable, well, we would think it's somewhat reasonable, but we can not include it in the income, right?
That's right. If it's say something like 50 cents a kilometer, then we know at least we've got this part, we've got the kilometers part. Then we just have to go and do the math to see if it's reasonable. And who can recall for me the reasonable math?
50 to 200%?
50 to 200% of
Actual cost.
actual costs. So that range we say is receivable, is reasonable. Anything else on that? 50% also said they're having trouble with whether to include GST, open bracket, yes, and PST, open bracket, yes, I gave you a hint, in employment expenses. The short answer is all employment expenses that we're deducting need to include both GST and PST. Does anybody know the reason for that?
Because employees are not GST flow-throughs, they can't claim it.
Employees have no way to claim back the GST they pay, so the GST becomes an actual expense for them and an actual cost in the case of buying a car. So unlike the business income thing, for an employee, always add both taxes. Therefore, I need to give you both taxes. expenses deductible by salesperson, third calculation, whether a higher deduction is available by claiming as a non-salesperson. 75%. Let's talk that through. Is everybody familiar with the Andrew example? Is there anybody who's not or doesn't know what I mean by that? So Andrew, when doing the calculation based on commission expenses, got limited because commission expenses were low. Second calculation is to add to that commission expenses plus those other things like car CCA and interest. And that didn't work as well as he wanted. So then he said, scrap that, I'll just do it as if I'm not a salesperson. And found that he got a higher deduction limit, and that was the one he used. So first of all, that's the logic. We're able to do the calculation 3 ways, and we're allowed to deduct the highest deduction that those calculations produce. No higher, of course, though, than the actual expenses themselves. So you okay with the logic part? Maybe there's just an issue about the mechanics of it. Please come and see me if you need to know more about that. As you might expect, there will be a question like that on the assignment. And when you've got the assignment out, take out the spreadsheet that Cindy prepared, or take out the Andrew example, or both, and just work it through step by step. Take a lot of time to do the assignment. Some of these questions and answers, I spent 4 hours a piece.
Per question, you mean?
Per question. You will spend less. It's actually easier to do than to create.
Okay.
But I'm telling you, you need to spend a bit of time on this. Do not be in a rush.
How many questions are there?
There will be, I think it's like 8 or 9 or something.
Okay.
And believe me, the salesman question, if not the biggest, it'll be, the second biggest. I mean, these are questions like you see problems in the textbook. So the exam was about key concept questions, and these will be more like problems. Just spend some time and go slowly. Anything else on that before I move on? Thank you to the students who completed that. I do appreciate the feedback, and hopefully it's helpful to report back.
When are you posting the survey for chapter 9? You know?
Tonight, after we're done chapter 9.
I'm just.
Because how could you respond if you didn't know?
Well, no, I was just wondering if the reason why you didn't get more than 8 people was because people weren't, I don't know, you did say it last class, but I was just wondering if people weren't paying attention.
How do you find this survey idea? I mean, the clicker would be cool. We don't have that. I could probably get that, but yes.
Oh, I thought it was good. No. Thumbs up.
Are you one of the 8?
I think I was.
Okay.
Yeah.
You know that list that you post of
Yeah.
the concepts that you're going to be testing on
Right.
per chapter? Is there any way to get that before you do the chapter in class, or?
To be honest, I don't prepare it until I prepare the lecture,
Okay.
and that's the only reason.
Okay.
I mean, I'd love to do that, and then you would probably just read those
Yeah.
items, right? Yeah. But I actually don't prepare it until I prepare the lecture. Good question. Anything else? You recall what I'm trying to do is work backwards so that the exam is prepared from a list of topics that you have had the opportunity to tell me that you're having trouble with. So that I can sort of fix things earlier on, and then hopefully things will work out better for you in the exam. So it's in your best interest. But let me say this, if you can think of a better way, like if it's just better for me to come into class and say, who's having problems with chapter 4 and let's go for it. I like that idea a lot. I'm just worried that it might take a lot of time and therefore rob the discussion on whatever comes after chapter 4, or chapter 9, or 10, or 15, or whatever. So please give it some thought. If you've got some ideas for me, let me know. I really do want to hear from you what your issues are. Videotaping of lectures. Obviously, some folks aren't here tonight because they're writing whatever it is, advanced accounting or equities or something, and that's a big deal, and I'm happy that this might help them. I'm happy that it might help you also. I do not take attendance in this class. I know that from time to time you might say, well, if it's going to be on a video, why would I come to class? And I don't disagree with that. And I won't blame you if you take that opportunity to not come to class. I'd be really happy if you were therefore someplace else doing tax problems, but I know that might not happen either. The only thing is, there's a risk that, I don't know, I bang this thing off the table and therefore there's no lecture to post or no audio recording, that is. So just keep in mind that if you're relying on this really strictly, that you might have a problem if we ever have a technical difficulty or the battery runs out or what have you. But I hope it's a really good tool for you, and I'll do my best to make it work for you. Please turn to section 69. So you recall we were talking about this idea of people dealing not at arm's length, so generally speaking family members, and those folks are defined in section 251. So a related person is deemed by section 251 not to deal at arm's length, and therefore when they transfer property between them, section 69 applies, and these are examples. So if I make a gift to someone, my brother let's say, and therefore get $0 for it, that's a gift. I am taxed on proceeds of fair market value, in this example $1,000, and he gets it at an adjusted cost base of $1,000. And do you remember what piece of section 69 says that? Any others? So close.
What's the part above that? It says, the taxpayer shall be deemed to have acquired it at fair market value, where the taxpayer is disposed to person for no proceeds.
So in this case, the gift of $0, both are taxed at the fair market value.
Yes. So what happens is it says, where taxpayers disposed of anything, which is B2 as Marlo said, to any person by way of gift, inter vivos, which means during their lifetime, the taxpayer shall be deemed to have received proceeds of disposition equal to fair market value. You were right, sorry. Let's call that B. Okay, that's 69(1)B. And then what's the support for my brother's adjusted cost base going forward being fair market value, which is $1,000?
The part right before the semicolon in A, it says the taxpayer shall be deemed to have acquired it at fair market value. Isn't that the acquiring part?
Yes. Very good. So A?
pay at the, yeah.
How about the second case?
Says less than fair market value.
Yeah, so B1, right? So it's where the taxpayer has disposed of anything to a person, my brother, for proceeds less than fair market value. So B1. And where does it say that the cost base is only $1? And somebody asked me this question last lecture, so I thought I would give you the answer today. Nowhere. Nothing in section 69 says anything about that. Which is why the cost base is only $1. It's what my brother paid me for it.
Because there's nothing in the act that says otherwise.
Because there's nothing in the act that says otherwise.
Oh.
What if the brother paid like $200?
$200.
So less than 1,000, would you forward the 200 over?
$200.
Okay, so whenever it's less, you just move it over.
Right. But what will result from that?
He'll pay capital gains when he sells it. And this guy's also paying capital gains, so double taxation.
Double taxation. So the place where we actually get some help here is in the gift scenario, as we said on Tuesday. If you try to be cute by paying $1, the giftor still pays tax based on fair market value, and the person who received the gift, his tax base is what he paid, which is only $1, and there's nothing in section 69 that overrides that.
So the moral of the story is they want you either to outright gift it, in which case you're gonna take the tax consequences, or they want the other person to pay for it at fair market value, in which case you're still gonna take. So they really just wanna make sure that the guy selling is taking the tax consequences, and if he doesn't, then they'll fix his wagon.
That's probably right. In any case, it is what it is, and these are the rules we need to know, and I need you to know where in section 69 these things are.
Ooh.
Let's look at the last case, which is my brother pays me more than it's worth.
Sorry, can I ask you one question about that? Yeah, that second one. So obviously, from the seller's point of view, they would know that the brother would be paying way less tax than they would. So would that be the reason why they wouldn't want to sell it at $1? Because they know that even if they do so, they would be paying a way higher tax than the brother would be?
I think people just do this out of ignorance. They just don't know what the tax rules are, and they think that if they... I don't think people actually do this by way of planning,
Oh, okay.
because we do end up with double taxation. I mean, even if tax rates are favorable, we still end up paying, two people end up paying tax, and that's never a good thing.
Don't two people wind up paying tax in the gift scenario because they're being taxed on fair market value?
Don't two people end up paying tax in the gift scenario?
No,
Why not?
because the person who's selling it should be paying capital gains on the difference between fair market value and what they bought it for.
So this person's paying tax, right?
That person will pay capital gains, and that person doesn't have to pay anything except what they end up gaining from the point of acquisition forward, which is the way it should be.
Correct. So in other words, if we sold this the next day for $1,000, this person would pay no tax. And if we sold it for, say, $1,500 the day after, they'd pay tax only on the gain between $1,000 and $1,500.
Thank you.
Pleasure. So now we transferred it higher than fair market value. Where does it say that the proceeds is $2,000? Nowhere! Very good. There's nothing in section 69 that overrides that. So it's just the proceeds are the proceeds. Oh crap. Where does it say that the cost base going forward is only $1,000, the fair market value?
In 1A,
In 1A. Because we acquired something in excess of, at an amount in excess of fair market value. The taxpayer shall be deemed to have acquired it at the fair market value. Anywho, all the action is in 1A and 1B, or by silence. And it's interesting, sometimes in the Tax Act, or actually any type of law, sometimes what is not said is just as important as what is said. Any questions on that? Now let's put it into practice with some other cases. Closely related to this are the so-called attribution rules. Please turn to page 333.
You're talking about in the textbook?
In the textbook. Because in the Income Tax Act, I don't tell you what page. You have to find it.
think so, that had me going for a second there. I was all ready to flip to section 74, but there you were, going back to the textbook.
Show off.
Yeah.
Very simply, when there's a gift between spouses, two things happen. The first is Section 69 doesn't apply. Even though spouses deal not at arm's length, there's an election that can be made, Section 74, that says no tax payable on the gift. So far, so good. The problem is that when that happens, the income that gets earned on whatever was gifted, for example, a GIC that earns interest, that income comes back to me on my tax return. We call it being attributed back to me. A better example is a stock. If I give my wife a stock or she gives me a stock, there's no gain or loss at that time. But all of the dividends on that stock come back to whoever, bounce back to whoever made the gift. And so does the gain or loss when the stock is ultimately sold.
So when you say dividends bounce back, that means that would be like an income, so it needs to be appropriately allocated underneath the right person's tax return?
That's exactly right. So again, dividends, I use the word bounce back. Even though there's a slip, an income tax slip with my wife's name on it, I have to report that income on my tax return because I made a gift to her. Yes?
What if you buy a stock with like a joint account or something?
Excellent question. What if you buy a stock with a joint account or something? That's a really tough one. A lot of people sort of split it 50-50, and I've seen that happen a lot, but really what Revenue Canada is interested in is where did the money come from? And if there's only one income earner, and they come and audit you, and they say, well, I know it's in both names, but I mean, the money must have had to come from this one income earner, let's say it's the wife in this case, then they would put 100% of it on her tax return, not 50-50.
So does that mean that it's actually in your best interest if you have some income in the lower income spouse's name? Like if they actually have real income, but it's substantially less, that it be in a separate account so that you can actually more easily justify to Revenue Canada that this was paid for by so-and-so?
Everybody hear the question? Does it make sense for the lower income spouse really to have a separate account in that person's name to better justify reporting the income therefrom in that spouse's tax return? The answer is absolutely. People get married and they think that the first thing they need to do is set up a whole bunch of joint accounts, which is fine. And my wife and I have one. We just use it for buying groceries and stuff. But we very much have separate accounts for investing, and the money came from her, or the money came from me. And we have a clear division so that I can show that the money that's accumulated in her name is this much, and she has to pay tax on it at her low, or she gets to pay tax on it at her lower rate than mine, and I don't have to pay tax on it. And we've done this since we were about 25 years old. We got married when we were 22, and she actually made more money than I did. She was a teacher and I was a CA student, and she made 50% more as a teacher for about 5 years than I made as a CA student. How does that feel? Anywho. But right from sort of day one or close to it, we set up separate accounts. And as things went on, got better, and we were able to pay all of our household expenses out of my income. And then her income went straight into an investment account in her name. And it grew like this, and mine's paltry, but hers is huge, which will be great in retirement. Well, it's great now because she reports that income at her tax rate, which is lower than mine. And in retirement, it'll be even better because my pension is higher than hers. So these are the kinds of things that over 30 years, it just takes time, but you can really get some substantial tax savings going by having done that from an early date. So the thing for spouses should be that you should also have some separate money for tax planning. So attribution. Can anybody think of, now that you know what the tax rules are, the income comes back to you, are there any good reasons to make a gift between spouses? I did this. I did it for creditor proofing reasons. I had money, my paltry money in my name. I gave it all to my wife. Told my investment brokers what I was doing, and they now issue the slips in my wife's name, and I report them on my tax return because it's the right thing to do. It's attributed back to me. It is my income. It would have been my income anyway if I had kept it in my name, but it's in her name, so that if I got sued, someone would have a tougher time to get that investment money because it's in my wife's name, not mine.
Well, and when you say for credit, does that mean too that if she went to take a loan out, because it's in her name, it's actually hers? So even though you get the income attributed to you, she can use it as collateral for another loan to buy some more investments?
Yes, my wife could have used that account, which is in her name, because legally speaking, the money is hers,
Right.
to borrow money, say to buy more investments, or what she probably would have bought with it, which is furniture.
Not shoes.
No, she's not into shoes. She's into furniture and kitchens. And but that didn't happen, thank God. But I had no control over the money. I mean, she could have spent it on anything. And
But that would be another good reason to actually gift property to a lower income spouse, right? So they could use it as collateral to.
sure. They're taking on more risk if they do that. That wouldn't be my first choice, but certainly someone could actually borrow that money or use that money to borrow money to invest in and do even better. But I've got a better idea for you in about 10 minutes.
Okay, I'll stay posted.
Good. Minor children, children under the age of 18. Same deal. The income gets attributed back to me. Two differences. First is there's no spousal rollover. This thing where I said that there's no Section 69 deemed proceeds, I can just make her a gift and there's no capital gain to me. We call that the spousal rollover. No such is available on a gift to children, minor or otherwise. In fact, the only people who can enjoy that is a spouse. So a gift between spouses is always tax-free. But if I make a gift to my minor children or my grandchildren, we talked about a share. I have to pay capital gains tax on that share. Oh, and the dividends that my minor children or grandchildren enjoy go back on my tax return. They get attributed back to me.
Until they're 18?
until they're 18. With one difference, capital gains, for some reason I can't explain to you, are not attributed back to me. So I might prefer to gift them a share that doesn't pay dividends, BlackBerry, rather than say Apple, which does pay a dividend. Because if BlackBerry does well and they have a capital gain, they can report that capital gain on their tax return. I do not have to report it. But if they buy Apple shares, which pay dividends, I have to pay tax on those dividends until they turn 18.
Is the capital gain part, even if they sold it before they were a minor anymore, an adult?
The capital gain part is only if they sell it. So it's not, there's no like accrued capital gain or anything like that. We're only talking here about realized capital gains.
No, but what if they sold it before they were an adult?
If they sell it before they're an adult, no attribution back to me, it goes on their tax return.
Oh,
It
okay.
doesn't bounce back to me.
Oh, okay, so them turning adult doesn't make a difference for the capital gain, it's theirs.
Turning adult, the age doesn't matter as far as capital gains that they earn.
For the RESP, can you use that for a kid's, like private school tuition before they turn 18 if you send your kid to private school, or how?
Can you use an RESP for private school before they turn 18? No, you can't use it for private school at all, regardless of their age.
So is there anything that parents can do? Or do they just pay it out of pocket?
They just pay private school tuition, they just pay it out of pocket. I've heard of some schools that say, well, the tuition is this much, but we'd sure like if you gave us a charitable donation.
Oh,
But that's as much as I've heard of, and I'm not crazy about that. Please look at page 333. So here's an example. A wife gifted shares of a public corporation to her spouse. At the time of the gift, the wife is deemed to have sold the shares at an amount equal to their adjusted cost base. That's a good thing. No gain to her. She got the spousal rollover. Et cetera, et cetera. Later on, there's dividends received and then shares got sold. So the dividends go back onto the wife's tax return. And so does the capital gain. Look where it says, to the extent that the spouse invests the dividend of $1,000 and the capital gain of $18,000. And who paid tax on those? The wife, the giftor. The income on the investment, on the reinvestment, will not be attributed back to the wife. So there's no attribution a second time. So wife makes a gift, husband gets the dividend and capital gain, reinvests them. Wife pays tax on the dividend and capital gain of the first instance. The reinvested money gets invested, earns little bit of capital gain, little bit of dividends, I guess. That sticks on the husband's tax return. That requires a little bookkeeping by the client, by the taxpayer, or maybe even setting up a separate account. There's a good idea to reinvest the income into. You should keep that separate because that second level of income isn't attributed back. There's no bounce back on that. The rest of the discussion in the book is quite good actually. So I'm speaking here of pages 333 and 334. Split income. I do want you to know that. That is a special rule that applies where minor children earn dividends from a private Canadian company where shares were gifted to them. In that case, what happens is there's no bounce back on the income, on the dividends, but the minor children have to report the dividends and pay tax at the highest tax bracket, regardless what the tax bracket is of the person who gifted the shares. The person who gifted the shares may not be at the highest tax bracket, but the children here have to pay tax at the highest tax bracket on those dividends.
But if you're trying to transfer money to your child, I mean, the bottom line is this would still work. It's just that they would be taxed at a very high rate.
It's a terrible thing to do, though. I mean, the only benefit you can get out of this is that the kids could reinvest the dividends, and there wouldn't be a second incidence of this tax. But it's so onerous, I wouldn't even suggest to anybody to do it. I mean, you can't get any worse result than being taxed at the highest rate. Yes?
Let's say there is an unexpected dividend, can you attribute it back to yourself if you don't want it? No?
An unexpected dividend, always a good thing, but still always subject to these rules.
Well, but I think in this instance, they're talking about when they say a private corporation, I mean, they're talking about a lot of times, if, for example, if a doctor decides he wants to become a private corporation, then his kids are shareholders. So I mean, there's no surprise. He's the guy deciding when to dividend, right?
Yeah, that's right. A private company is, often a family company, and there's somebody pulling the strings, a family member, mother or father. So, I mean, it's all within the control of the company or the shareholder or somebody. So, it would be quite a surprise if an unexpected dividend showed up. I guess paying tax is not the worst thing in the world. You're still happy to have the unexpected after-tax dividend.
But what you're saying is that dividends are not taxed at a very high rate to start with, so this would really be punitive.
This would be punitive because, as I said, the dividends would be taxed at the highest rate, regardless of the tax rate of the giftor. The giftor might be at a lower rate. You can go to page 335 and forget about transfers and loans to corporations. We'll talk about that in a later chapter. So I've just drawn a line through that in my textbook. Please look at loans to adult family members. You're about to hear one of the best tax planning measures that exist right now. Just take a moment to read what the textbook says. It makes it sound like there's a big rule here and a big problem that has to be avoided. Specific anti-avoidance rule, etc., etc. It says, when a taxpayer makes a loan to a non-arm's length person 18 years of age or older, so me to my wife or me to one of my kids, all of whom are over 18, with no interest or charges interest below a commercial rate, bad things happen. Well, all you have to do is charge interest at a commercial rate. And CRA accepts as a commercial rate the prescribed rate. Do we all recall what the prescribed rate is from Chapter 4? 1%. There's a once-in-a-generation tax planning opportunity here to loan money to an adult child or your spouse if their tax rate is lower than yours. And then they earn whatever dividends or interest or what have you in their hands, and there's no bounce back because they invested it themselves in their name using money that they borrowed from me, as long as they pay me a reasonable rate of interest, which is 1%. Remember what I said on Tuesday about reasonable expectations for stock market returns, like dividends and such? Give or take 6%. Well, I have clients that lent their spouses $1 million. The spouse pays them interest at 1% per year. How much is that? $10,000? It does have to be paid, and there's a sticky rule. It has to be paid by 30 days after year end. The same 30-day rule we talked about in terms of employee loans. So they can go to the stock market and make, say, $60,000, pay $10,000 in interest to the loaning spouse, and what the spouse's tax return looks like is dividend $60,000 minus $10,000 interest expense equals $50,000. And the spouse that loaned the money, their tax return looks like interest income $10,000, and that's all.
For the actual handoff of the money, oh, sorry,
Go ahead.
okay. For the actual handoff of the money, can spouse A just give 1 million less 10,000? Or do they actually have to show the 1 million being transferred into spouse B, even if it gets transferred in and immediately they transfer 10 grand back, that would show the transaction, right?
You need to make it a transfer of $1 million with a loan document,
Oh, okay.
and there'd better be a check and a cancel check for the payment of $10,000 interest each year. It's not just enough to sort of write a check for $990 at the beginning and say it
Okay.
covers both.
Okay.
Yes.
Um,
Oh, and by the way, what this needs is someone with a lot of cash, and the clients that I speak of obviously had access to a lot of cash to be able to do this. And by the way, it need not be done with $1 million. It can be just as easily done with $10,000 or $1,000. The point is that it's possible to put large amounts of income into another person's hands without having the attribution rules apply.
you say large amounts of income, but they don't get a deduction or anything for transferring it, like loaning it, right? So, what are they?
What deduction do you think that they should get for loaning it?
An interest expense? No, just joking.
What they do get, see, if I had $1 million, if I had $1 million, if I had $1 million, I would be investing it, right? And I would be paying tax on that $60,000 I speak of.
Okay,
So that's what it is. It's an opportunity benefit.
so just the property income is at a lower tax rate.
That's right. The property income moves off my tax return, goes to the lower income person. It's not perfect because I do have to pay tax on the interest income coming back. Hey, I'm happy to do that. And this is forever.
Well, and realistically, you've already paid tax on that $1 million. This is after-tax money you're talking about. It's just the like you have to do something with that money to generate more income, right? 'Cause
Right.
why would you sit it in your bank, right?
That's right. Or I mean, if
So we're talking about.
the point it is in the bank or in my investment
Right,
account,
right,
and
right.
I am earning interest or dividends on it,
Right.
which is great. It's just that the income is in my name, and I just want to move it off to somebody else's.
In your tax bracket too.
And I want to make this point again, this is forever. If you start this now with a 1% prescribed rate, if the prescribed rate goes up to 10%, it's the 1% that you enter into, it lasts forever. So you can keep this going for a long time, even after interest rates eventually rise. So shame on the textbook people, they show this as like a big problem, and if you had only read these words, you wouldn't know that this is actually one of the biggest opportunities in tax planning between spouses right now, and with adult children as well. So go home and explain to your parents why they should lay $100,000 on you.
It said something about, if they lend you money for personal expenses or to acquire non-income property, then it's all moot.
Correct,
I guess because there's no income, right?
exactly.
How about, I just wanna ask this one question. If spouse A gives spouse B $1 million and spouse B has absolutely no money in their account, that 10,000 interest comes out of that 1 million. Is that still cool that that interest is paid out of that?
It's a good question. So spouse A loans money to spouse B. Spouse B has like no money before this $1 million comes in. How does spouse B actually pay the $10,000? Do they pay it out of the $1 million or just what? No, they pay it out of the dividend income that they earn.
Okay.
So, and that's mirrored in their tax return. They earn $60,000 worth of dividends. That's cash that comes to them. Now they have cash with which to pay the interest that I spoke of. But you raise a good point. What if somebody just used that money to buy growth stocks, and which don't pay a dividend, and they're just holding the stock, so that on January 30th next year, there's no cash with which to pay the $10,000. Well, that is a problem. And I don't know how to fix that. I mean, I guess you could go back to the spouse and say, can you lend me 10,000 more, and then I'll pay you back and stuff. Well, yeah, I guess you could do that, but
Well, if you had $1 million of growth stocks, don't you think a bank would lend you $10,000 to pay interest?
yes, a bank might lend you $10,000.
Well, still, I mean, you need 10 grand, right?
Sure. I would rather see people, though, invest in some income earning thing to take advantage each year of the difference in tax rates. I mean, it's nice to buy a growth stock and maybe sell it in 5 years, but you might actually be missing out on some tax savings because when you sell it in 5 years, maybe your income will be so high from that it'll put you in the same tax bracket as the person who made the gift in the first place. So I would rather see them invested in income earning stuff for that reason, and also to provide income to use to pay back or to pay interest on the loan. Last.
So what would happen if the initial borrower gave the person the money to pay back the interest, because they are really, I mean, spouse and husband, how if they just gave the person, what would be the tax consequences if CRA found out about that?
All of the income would come back on the spouse's hands because they wouldn't have a real loan agreement because they're not really paying interest.
So they can use the money for property earning investments as long as they charge 1% for the prescribed rate.
Yeah. The prescribed rate, which right now is 1%. Honest to God, it's almost crazy to talk about, but that's what it is. And the people who do tax planning have been afraid for years that the prescribed rate would go up. But you can tell from the table, I think it's been at 1% since 2009 or something like that. And nobody sees interest rates going up anytime soon, so there is still time for people to get onto this. If you don't mind, I'm going to move on. Page 335 is a very good explanation of income splitting permitted by the Act. We talked about spousal RSPs. This pension stuff, don't worry about that for the time being. So the first bullet point, the third bullet point, we're going to cover that stuff in later chapters. Universal Child Care Benefit Program, good to know, but you don't need to know it for this course. Capital gains on property transferred to minors are not subject to attribution as demonstrated above. You need to know that. Income from property transferred to children over the age of 17 is not attributed to a parent. So the age of a child is important. This attribution I spoke of is about minor children.
Why 17?
Over the age of 17, so they're 18 or higher.
Oh,
It's not written well. I would have said 18 or
what an
higher.
awkward way of saying
Yeah.
that.
Because a kid who's 17.2, I would have, yeah.
Thought they were 17.
Within specified limits, an individual can contribute funds into a spouse's TIFSA. Question was asked, or I mentioned that, or someone asked, can you do that with an RSP? The answer is no. And I mentioned that I did this. I went back today and I spent an hour going through my own portfolio records to see what I actually did. And luckily for me, what I actually did was I took money from an account, the one that I had gifted, I said before, I gifted money to my wife for creditor proofing. I took money out of that account to make my RSP contribution for 2012. Thank goodness I took it out of that account and not her real investment account, which was her money since day one. So this money that's in her account that I gifted to her, for tax purposes, that's really my money. So it's okay for me to take that out. What is the harm if I take money out of her real investment account and I make a spousal RSP contribution, which means it's her money someday? What's the harm in doing that?
Her limit is probably different from yours.
Her limit is different from mine, and I am claiming a deduction wrongly because if I'm contributing to her spousal RSP, I am claiming deduction using her money, and that's not right. So luckily for me, I took the money out of the correct account, used it to make my RSP contribution spousal in her name. So I learned something, and I'm glad I'm on the right side of it. Unpaid remuneration, we've covered already in an earlier chapter, so don't worry about that. Don't worry about item H either, but I would like to talk to you about item I, which is gain on settlement of debt. If I use the word forgiveness of debt, settlement and forgiveness are interchangeable. So I owe somebody money, and I go to them and I say, I can't pay you, and we make a deal, and I pay them either zero or I pay them less. What is their treatment? They obviously have lost money.
Isn't it a loss applied against a gain on their side?
Remember section 50 bracket 1? Where if I have a loss on a loan, I get a capital loss. 50 bracket 1, so they get a loss. As one might expect. And their loss might be enable if it was a loan made to a small business corporation. Chapter 6. Question is, what is it to me? I'm the person who was forgiven. My journal entry is debit loan payable, credit something. Something good, like a gain or something like that, if we're talking in accounting terms. Do I have to pay tax on this money? Is it income to me? This loan I used to have that's been forgiven. The good news, it is not income to me. But the Income Tax Act makes me reduce some good balances carried forward. So for example, top of page 337, if I had non-capital losses, so losses that arose from usually business or property, they get wiped out to the extent that, say my loss is $10,000, but my forgiveness is $50,000. So my losses get wiped out. You can draw a line through farm losses and restricted farm losses. But I might have some ables carried forward that I wasn't able to deduct. They get wiped out. And then finally, net capital losses, they get wiped out. So one by one, in this order, my losses get wiped out. If my forgiveness is even bigger than my losses, I go to a next step that reduces the adjusted cost base of my assets, for example, investments, UCC of depreciable property, etc., etc. So it's reducing good things, and therefore someday I will pay tax. For example, when I sell something, if my ACB is reduced, I'll pay more capital gains tax than I would have without the forgiveness. So it says in the second full paragraph, when the cost of these assets is reduced, any subsequent sale results in either a greater gain or a lesser loss for tax purposes. And then, if all the forgiven debt is not consumed by applying it to all of the above, finally, 1/2 of the remaining amount will be included in my taxable income. And that's the case if I don't have losses and I don't have investments and stuff, then I pay 1/2. Why 1/2? because the person who loaned the money is getting only a capital loss thanks to section 50. Therefore, they're only getting a 1/2 deduction. Therefore, symmetry would say that I should pay only 1/2 income.
How come they don't refer to section 50 in the book?
I don't know. Death of a taxpayer. Page 337. You can draw a line through reserves and unmatured RSPs. Matured RSP, that's one that, say I'm 75 years old and I'm receiving income from an RRIF. If the beneficiary is my wife, so actually tell the bank, look, if I die, it goes to my wife, please. Not to my estate, to my wife. Then there's a rollover. So when I die, I don't have to pay tax on it, and my wife doesn't have to pay tax on it. They just change the name on it, and then she takes the RIF payments over time and pays tax on them at her rate over time. So nothing bad happens when I die.
When you use the term rollover, does that always mean there's no tax that has to be paid on either part?
Rollover means there's no tax to be paid on either part. We'll see that expression used not just in this case about spouses and stuff, but later on as well, as far as corporations are concerned. Page 338, number 2. All capital property that was owned by me is deemed to have been sold at fair market value. Big capital gain, hopefully. Except if I leave it to my wife. And again, my will has to be very explicit about this. It has to say, I'm leaving it all to my wife. Because if it just goes into my estate without mentioning my wife, fully taxable, but to wife, spousal rollover. To say it more succinctly, there's a deemed disposition of all my property at fair market value, except what I leave to my spouse. Draw a line through number 3 and number 4. Draw a line through K and the rest of the chapter. Your big takeaway on chapter 9, please, is about the attribution rules. If you get the attribution rules, you will have no trouble with chapter 9. And if you know how to calculate an RSP contribution room, you'll be good. Chapter 10, please. Page 367 is a combination of pages 36 and 40. Remember 36 is about section 3, thank you. And page 40 shows sort of the below the net income line to arrive at taxable income. So here it is nicely on one page. So henceforth I'll no longer be referring to pages 36 and 40. Capital losses. Capital loss is when I sell something like an investment and my proceeds is less than my adjusted cost base and I have a loss. The loss that we get in the year is called an allowable capital loss. We call it an allowable capital loss. See that on page 367? So that's the amount by which taxable capital gains exceed allowable capital losses. So an allowable capital loss is a loss that I have in 2012. If I have no taxable capital gains, I carry that forward, and now it's called a net capital loss. So there's a little naming thing I need you to know. Allowable means what I've got for the year. Net means what I carry forward. And how long can I carry it forward? Forever, indefinitely. And I can carry it backward too if I had gains in the prior 3 taxation years. And it says that in 111(1)(b). Please turn there.
Sorry, what's net is carrying forward, right?
Net is carried forward or carried back.
Okay.
Now I'm showing you this for 2 reasons. The first is, as I may have mentioned before, that the way that they write this in the Income Tax Act is sort of backwards. It doesn't say you can carry losses back 3 years or forward forever. What it says is that for this year, (111)(1)(b), for this year I can claim non-capital losses for taxation years preceding. So that means like all taxation years before. I can carry them forward to this year. So if I had losses in 2007, I could carry them forward to this year. Or 3 taxation years immediately following, so that's the taxation years 2013, 14, 15, I can carry them back to this year. So it's kind of written backwards. So I want you to see that. Partly I also want you to see it because you'll say, oh, how many years can I carry back? This tells you how many. Non-capital losses, 111(1)(a), written the same way, back 3 and forward 20. So now you know, if you have to refer to it, how many years can I carry forward? 20. Ables are a little bit different. Please go to 111 bracket 8. You recall what an able is? That's where I have sort of a capital loss on a loan or shares of a small business corporation. The good news is I can deduct that against all types of incomes, not just taxable capital gains. Therefore, since I can do that, it is very rare that ables get carried forward. But I do want you to know that they can be carried forward 10 years. If they're not used by then, they get converted into a capital loss. Then they can be used forever, but only against taxable capital gains.
And where does it say that? Where did you direct this to?
The only place it sort of says that I need you to know about is if you look in 111(8), in the definition of, let's see. In the definition of net capital loss, this is 111(8), definition of net capital loss. A minus B plus C minus D. C what happens is after the 10th year, it becomes part of C. So it's the least of the amount of the allowable business investment losses of the taxpayer for the taxpayer's 10th preceding taxation year. That means that if I haven't used them in those 10 years, it comes in as a net capital loss because it's included in C in this formula. So if you draw a circle or highlight the 10 and put a note saying, able gets turned into capital loss, net capital loss, after 10 years, that's the place. Please look at the bottom of page 369 in the textbook, Cindy.
Yes, thank you. What page?
This is a good example which I'd ask you to have a look at on your own. The reason it's good is it shows when a person has losses, sort of what they can do with them. It also reinforces that net capital losses can only be used against taxable capital gains, which you already know, but Here's how it works. Please go to the bottom of 370.
So are we skipping farm losses?
Yes, please, skip farm losses and restricted farm losses. Thank you.
So you want us to know the sample calculation of loss carryovers?
Yes, please.
Wow, this thing goes up to one next page?
Yes.
Pretty insightful.
Want you to make this note for when you look at this example.
The D?
This is, but by example, I mean in D. So it starts on page 369, goes to page 370. The person did not claim their maximum non-capital losses. They should have. What they did instead was that they, let me just show you exactly what I'm talking about here. Yeah, if you go to the bottom of page 370, the paragraph that says a second alternative. I need you to read this really closely because it's a big tax planning deal. The taxpayer could have chosen to claim the maximum non-capital loss of $21,000 to reduce the net income to zero, thereby leaving the entire net capital loss for future taxation years. This may be prudent if there's a possibility that the non-capital loss, which has a shelf life, which has an expiry date, will expire before it can be used. The net capital loss can be carried forward indefinitely, awaiting a taxable capital gain. So we've got a sort of a planning option here to use net capital versus non-capital losses. In my memory, this 20 years was only 5 years at one time. 5, 7, 10, now it's 20. And we took every opportunity to make sure that we were using our non-capital losses before they expired. And we took a chance, we said, well, let's use them instead of net capital losses. We know that we can only use net capital losses if we have capital gains, but we'll roll the dice and take that chance because we've got forever to earn a net taxable capital gain. So I'd like you to look at that example in this context and look at the timing of, or what kind of losses we claim. If we're in year 19 of the 20, you're darn tooting we're going to claim the non-capital losses and leave the net capital losses going forward. If we think we'll never have a capital gain, which is a depressing thought, but I guess some people feel they may never have one, then I guess they will use the net capital losses and save the non-capital losses for something else. Page 371. The point of the example here is that we can only carry losses back 3 years. So for example, if I start a business and I have a profit in year 1 and a profit in year 2, and then break even and then a loss as it shows there in year 6. On a consolidated basis for all years, I've got break even. Unfortunately, though, I'm paying tax on the $150,000 in years 1 and 2, and I don't get to claim the loss in year 6 against that. The best I can do is carry that loss forward if I can. Too bad. Had that loss happened in year 4 or even year 5, we would have had a better opportunity. We could have reduced our year 1 and year 2 taxes by carrying losses back up to 3 years. And finally tonight, if you look at page 372, again, let's think about a startup situation. Most people reflexively go to an accountant and a lawyer and they say, yeah, you gotta have a corporation right now. Okay, great, we set up a corporation. If we lose money though, we cannot use those losses on our personal tax return. Whereas if we had operated for a short time as a sole proprietorship and we have startup losses, which are very common, at least then we can carry those losses back up to 3 years and use them against whatever income we had. Losses inside a company like that, we refer to as dammed up losses. Like a water dam
You're talking about in a corporation?
in a corporation.
Okay.
Because we cannot do anything else with those losses, they just sit inside the dam. The best we can hope for is that hopefully the corporation will have profits going forward, that we can carry the losses forward for how many years? For 20 years. Thank you, and we'll see you on Tuesday.